Good afternoon, I'm Neil Yahn, and this is the AVI or video file for purposes of a brief explanation on the distinguishing characteristics between C Corps and S shareholders, and this is an illustration to give you an idea of the reporting requirements for an S Corp. So with that, here's what we have. We have 2007 calendar year taxpayer, which is O Inc. O Inc. has two equal shareholders. We have E and we have L. They own 50% each of O Inc. O Inc. for the 2007 calendar year had gross income of $500,000. It then had expenses of $300,000. So what's its net profit? Pretty self-explanatory. It's $200,000. That $200,000 then is distributed to the two equal shareholders if we're dealing with an S Corp. So let's clarify that up front. We have an S Corp. How do we know it's a corporation? Well, one of the telltale signs that you're going to look at, you're going to see O Inc. Inc. denotes corporation. If we had LLP, we would know we're likely dealing with a limited liability partnership. Although because of the check the box regs, you'll have a pretty good idea of what the entity is reporting at. And by entity, I mean whether corporation, partnership, etc. But in this case, we're dealing with an S Corp. It's got net profit of $200,000 that's going to be distributed equally to its two shareholders. S Corps require that each shareholder be treated equally by way or consistent with their percentage ownership. In other words, there can't be a special allocation. So we have a net profit divided in half if they're equal shareholders. $100,000 is going to be allocated to E to be picked up on E's individual income tax return 1040. L is going to pick up another $100,000 to ultimately be reported on his or her 1040. What's important to note is a S Corp files an 1120S. The copy of this form will be immediately adjacent to this video file on the website. So $100,000 will flow out via a K1, and another $100,000 will flow out to L on his or her K1. Now you'll see O Inc. also has a long-term asset that it's held for a while, which is not part of the gross income. That means it's held this asset as an investment. How does that long-term asset then be reflected? Is it picked up on the 1120S? Sure it is, but it's ultimately then distributed. If there's long-term capital gain on that asset of $60,000, how is that ultimately picked up by the shareholders? Well, $30,000 of it is going to be picked up by E via the K1, and the other $30,000 is going to be picked up by L on his or her K1. And let's think about this for a moment. That $60,000 is long-term capital gain. Each of these shareholders, because they're equal shareholders, is going to share in one half of that gain then. And the K1 is the informational document which will allow L and E to then have an idea of where are they getting this income from. So you follow an 1120S which passes through all of the information via the K1 to the shareholders for them to then adjust or accordingly pick up on their individual 1040. Let's think about this for a moment. Let's say we take away the S status and we're now dealing with the C Corp. Well, naturally, one of the differences that you're going to note is, and this is what's key to the double taxation, the C Corp files an 1120. Form 1120, I'll have a copy immediately adjacent to this video file as well on the tax journal site. On the 1120, it will pick up the $200,000 of net profit and report it. There will be no K1 in the 1120. So E and L may still be shareholders, equal shareholders in O Inc., but they're not going to have that reflected. There's not going to be a K1 pushing it out to the shareholders. The C Corp will file its own individual return. Also, the C Corp, if in fact O Inc. sold that long-term capital asset, whereas before I told you that Both E and L would pick up $30,000 of that long-term capital gain. In this case, because it's a C Corp, it's going to be picked up by O Inc., the corporation, on the 11/20. It's not going to flow out to the shareholders. And you say, okay, well, so the C Corp's paying tax. That's right, it's paying tax on this, and it's paying tax on this. In the other case, the S Corp, those items were pushed out to the shareholders to ultimately report in one setting or another. Now, the $60,000 long-term capital gains picked up by the C Corp, the net profits picked up by the C Corp. If the C Corp issues a dividend of $80,000, now we have an event that's going to impact the shareholders. And if $80,000 is issued, $40,000 is going to be picked up to E, another $40,000 is going to be picked up by L. And that's in the form of a dividend. And you say, well, what's the tax treatment of that dividend? Well, for the 2007 calendar year, both E and L will be picking that up at 15%. Mind you, depending on what happens in this year's presidential elections, there's been a lot of discussions as to what's going to happen to the the current dividend rate. But it'll be interesting to see. But note, in that case, then, if $80,000 is pushed out, both E and L will have $40,000 of dividend income. Important, the $200,000 would have already been taxed at the corporate income tax level. So that's taxed. Then there's an additional tax. What's that tax? It's the dividend that the 15% that the two equal shareholders are going to pick up. With that said, that's a brief, not exhaustive, explanation of a distinguishing characteristic between a C and an S Corp. Thank you.